Hey everyone, so Trupanion is a company that I first learnt about because of Rob Vinall at RV Capital and because he has a stake in the company. And I like Rob Vinall's high quality approach to investing where he likes to find these good quality people running long runway businesses. And I was also fortunate enough to meet the CEO Darryl Rawlings. So here we go, here are my thoughts on Trupanion, and I'll even attempt to value the business later in the video, but some background is important before we get there. Alright, so Trupanion is a pure pet insurance business. Now, this industry is pretty easy to understand. I won't spend too much time talking about why pet businesses are good businesses. I think it's pretty obvious why this industry is pretty great. Well, for one reason, 1 in 4 people value their pet's life as equal to a child. Regardless of the macroeconomic situation, if you have a pet and it's sick, you still go to the vet. And most people can't budget for a pet, so pet insurance is a reasonable solution for many people. Now, understanding an insurance business isn't the easiest, but it really isn't too hard either. Essentially, we want to see more money coming in through premiums across all the thousands of customers compared to the money going out to customers for the pet health issues. And I generally like the industry they're in. I have started to really shy away from business to consumer businesses though. Consumers are kind of fickle, trends change, and competition is more fierce because many people see the business opportunity. Most people don't see the business opportunity in, for example, transporting liquid gas containers in regional Canada. So what's their competitive advantage? Well, it's not like they are the only pet insurance company out there. There are many options and it's a fierce market. So Trupanion needs to continually spend their free cash flow internally and externally to acquire new customers.
There's a bunch of things that makes Trupanion's product unique. One is that we have truly lifetime coverage. I mean, we've seen in the marketplace that products that were reasonably good, the next year on an anniversary, they reduce the amount of coverage and the pet owner doesn't have any control over that. Ours is really about lifetime coverage to start with. It's unique in the approach in that we trust veterinarians, we trust the value that they offer, and we believe that if we have the broadest coverage and we have the best customer experience where we're trying to pay hospitals directly at the time of invoice and we're here 24/7 and we're supported by a culture and people that love pets, price is not important. What is important is the fact that we've got the broadest and best coverage.
That was Darryl Rawlings, the CEO, by the way. So anyway, Trupanion's unique selling point is a few things which I like. First thing is they have so much good information now about animals that depending on the breed, the location, and other factors, Trupanion can estimate the average life and medical expenses of the animal quite accurately. They add a flat 15% on top of this data and break that down into smaller monthly payments. Darryl actually explains it a little bit like the Costco model, but on pet insurance. And I like this. It is fair, it is clear, and it means the business can hopefully do this really long term, like Costco were able to do. So because of this method, the cost stays about the same for the life of the pet. See, a lot of other pet insurance companies fluctuate the prices you pay based on the age of the pet. Some pets are lucky, some pets are unlucky. You don't really know which one you're going to get, but Trupanion have figured out all of the numbers, and it makes it really simple and the same throughout its life. And it would take a rival company many years to get that data that Trupanion has, making it more difficult for startups to get going in this space. But it's not like another major insurance player couldn't just flick the switch and say, well, we now do pet insurance. If you already have, say, car insurance or home insurance, then it might be pretty easy to add on pet insurance. How many people actually understand the coverage they're getting with insurance? Well, not many. And this essentially leads me to my number one concern. Trupanion have to teach the customer that they are doing the right thing for their pet. But how many people actually listen? It's always going to be a battle. Hopefully their reputation over time starts to help, but still, it isn't going to be easy and competition will always be fierce. I guess one thing going their way is that vet bills are getting really expensive, and if you love your pet, you're going to pay it. Sometimes pet bills can get up into the $50,000 range now, so pet insurance is becoming more important, which I think is a good trend, but we'll see. Now, regarding management, Trupanion is founder-led. Darryl has about a 3.5% ownership in the business, valued at about $100 million. His salary is about $300K and gets about $4 million extra stock each year. So essentially, he's almost 100% tied to the outcome of Trupanion, and that's good, and so he's aligned with shareholders. And Darryl, I also think, is a good person and a good long-term minded CEO. At first, I wasn't impressed when I met him. He seemed okay, but I got this impression that he was just so close to the company that it's like his baby and he can't see the negative things. This is good and bad, I guess. I think he thinks his company is just more amazing than it actually is. He's convinced that it is like streets ahead of the competition. And look, maybe they are, but it doesn't seem like that they are the greatest thing since sliced bread. Now, the Trupanion annual letters are really great though. He offers a great insight into the important numbers of the business, and in 2019's annual report in particular, gave a great method of actually valuing Trupanion. Essentially, the business has been able to reinvest around 25 to 40% internal reinvestment rates for a long time. I'll save the heavy lifting of these numbers as it's all explained in the annual reports. I started reading from 2015. It's really good stuff. Some of the best shareholder letters I've actually read. And Darryl has plans all the way up until 2035, which is good to see he is thinking that far away. I like to see long-term minded CEOs. So regarding management, I'm definitely going to give him a pass, but I will want to temper his enthusiasm when I do my valuation. But it's actually pretty hard not to get really interested when looking at these numbers. So we've got revenue at 30% compound annual growth rate over 10 years, internal rates of return over 30% over 10 years as well, and adjusted operating income per share growing at 30% for over 10 years. Now, I don't like stock dilution, and there has been some stock dilution, but that is factored into that earnings per share growth rate. So now for the valuation. What you'll have to get your head around is the adjusted operating income. Most people hate adjustment numbers like this, but Darryl really spends a lot of time explaining the adjustments. The 2019 annual letter is extensive in this. Now let me be clear, you have to get your head around how these adjustments are made and whether you can get on board. If you don't like it, just avoid this investment altogether. So I'm going to approach this valuation today in a different way. Mostly because it is pretty easy for me to get my head around the risks. Plus, I like that Darryl has done a lot of the heavy lifting for me back in 2019. So this is how Darryl calculates the intrinsic value of the business. He spends a lot of time explaining this, and it's all really fascinating. So looking at the 2022 total cash generated number, he was predicting that it'd be 78.7 million for that year. But in 2021, what actually happened was they generated 78 million. So they already hit that number, probably a bit of a pandemic boost there. But essentially they're a year ahead of where they thought they might be. Now 2022 hasn't slowed them down at all. It is now looking like 2022 will be somewhere around the $90 million in cash generated number. And based on Darryl's method in 2032, which is the end of this table, the cash generated will be about 500 million. And that's about 18% compound annual growth rate in cash generated over the next 10 years. Okay, so today's multiple for a company growing at these speeds means that it's about a 29x multiple on that adjusted cash generated. What multiple is fair in 10 years' time? Well, your guess is going to be as good as mine. They're expanding into Europe, churn rates are low, and people love their pets more and more. My auntie is a vet, and things are not getting easier. People are getting more crazy about their pets and will do whatever it takes to save their lives. So I can't see the industry slowing down dramatically, but I do think competition is always going to be a thing. I think I feel comfortable with a multiple of 20. These high rates of growth just might slow down, so I think 29x is just a bit rich. So $500 million at a 20 exit multiple is about a $10 billion market cap. That's a 4x from here. This seems a pretty likely outcome, and I'm going to call that a 50% chance of happening. Now, if I think of a not very good scenario, I could see maybe only 400 million being reached, and maybe it's only a 15x exit multiple. So that would be a $6 billion market cap in 10 years' time. That's a 2.5 times return from here. It's less likely things would have to get far harder for the business. Let's say that's a 30% chance of happening. Then there's also the scenario where they beat their estimations. So maybe 600 million and a 25 exit multiple because of the stronger results. That would give a $15 billion market cap. That's a 6x from here. I do think this is less likely as the future is pretty hard to predict, but it is definitely an outcome that is possible, and I think it's a 15% chance. That feels about right. Now, of course, there's always the chance of mismanagement and this whole thing goes to zero. It's very unlikely with the track record they have now and the low historical churn rates. Let's give it a 5% chance of happening. So we have a 50% chance of, say, 4xing our money, a 30% chance of 2.5x, 15% chance of a 6x, and a 5% chance of a 0. Maybe. So at the current price, I think our expected return in over a 10-year period is around about 3.65x, according to those calculations I just did. That's about a 13, maybe 14% ROI from here per annum. So I think I may have been a little optimistic, I'm not sure, but we're probably right around fair value right now. So what price would I get really interested? Well, the current market cap is about 2.5 billion, and if the market cap was say 1.5 billion, well, let me make those adjustments. We'd get a 50% chance of getting to $10 billion, so that's a 6.6x. Then we have a 30% chance of getting to 6 billion, so that's a 4x from here. There's a 15% chance of getting to 15 billion, so that's a 10x, and still that 5% chance of 0. So at the market cap of 1.5 billion, I think our expected return, with some risk adjusted in there, is about a 6x from there. That's about 20% ROI, and that's about where I would like it. Factoring in multiple outcomes, I'd be interested at 1.5 billion market cap. That would be a very interesting price in my eyes. Turning that into a current stock price, that's about $37 a share. Now, I'm going to be the first to admit that this method is far from perfect. I could be wrong with those percentages, but that's how I feel about the business. So we have a good, big industry, but I worry about the competitive nature, and I don't love business to consumer businesses. We have a really good, thoughtful, long-term, highly incentivized CEO, yet I worry that he just loves the business too much. Maybe he's a bit too close to it. They have great internal reinvestment rates. They have a long runway to grow into, being still reasonably small compared to the insurance industry as a whole. I like the really clear annual reports, spending the time to explain to how the value of the business should be calculated. That is something that the outsiders in the book, The Outsiders, would do. And the price is okay, but makes me a bit uncomfortable at the current level. I would be a lot more comfortable somewhere closer to that $1.5 billion market cap. So a lot of really interesting things there, and this is definitely one for my watch list. And I keep my buy prices and intrinsic values updated in my monthly e-magazine. I use Interactive Brokers to do my investing, which is the safest of the brokers. Plus, don't forget about the Money Managers game that you can join and see whether you have what it takes to manage money. We're going to be following this over a long period of time, so jump into that. Everything is in the description if you want to find out more. Now, if you like what I'm doing, hit that like button for me, subscribe to the channel. I hope you've enjoyed it, and I'll see you next week.